Hello, YouTube. The S&P notches another green week with the bulls pushing with a higher low and a higher high and a green close. What this means is that now is the time. If Jerome Powell wants to change his tone, come out a little bit more hawkish, now is the time for him to do that. So is he going to blink? Is he going to blink? And that's going to be very important because this week we birthed a new bull market on both a closing basis and an intraday basis, which means if the market can't handle him changing his tune a little bit this week, I'm not sure when it will. And this is very important because we have to remember that most of the declines in a bear market occur after the Fed is pivoting. Keyword there being pivot. We're talking about a pause right now. So if this is it, we should be able to march higher, even if Jerome gives us that hawkish pause. Why? Well, because the pivot is not yet priced in. But we know the saying, we buy fear and we sell greed. Right now, we're in extreme greed. So that's what I mentioned in the title of the video. Maybe it's time to consider, again, keyword being consider, taking some chips off the table, realizing some profit, or moving up your stops. Why? Well, because we know the market generally takes a staircase up and the elevator down. And we've been staircasing up for a couple of months now. So now is a great time to sit back, to reflect on how we got to here and where we're likely going to go, because there's a couple of really big templates for us to look at. And we'll look at a chart, couple of charts in a few moments here, but it really comes down to this Fibonacci area here, 429.61, which we just closed over, and also our August high at 431.73, which we also claimed. So if we know that most declines happen after a pivot, not a pause, we know we're into extreme greed. Well, the market can remain irrational longer than we can remain solvent, which means more extreme greed, closer to 100, absolutely. But here's Jerome, Fed Chair Jerome Powell by day, a deadhead by night. What does that mean? He loves Dead and Co., or the Grateful Dead. Is the market going to be grateful to be dead after? This is Jerome Powell on June 4th at the show. So what I think, I want to touch on as well is just the fact that I've been talking about the seasonality chart for quite some time. It's worked as an excellent template or roadmap from January until now. And for May, very, very accurate. Not exactly on track with the timing, but same thing here for June. If we look at the chart and we look at S&P, what do we know? Well, into the close of the month of May, we rally back up. We get extensions higher. We get that push up, right? So we pop, flag, pop. Well, what is that? Oh, okay. Pop, flag, pop. Here we have our big climax. We should be going pretty much lower straight from here if we're still on track for June to close red. And that's important because we want to make sure we're mindful of what the chart is telling us. I thought it was going to happen this week. Well, clearly I was wrong. So I'm going to ask you for a big favor as we're getting started here. Please, if you could, consider smashing that thumbs up and subscribing to the channel. I would greatly appreciate that. Let's move forward with a few more key indicators, and we'll look at the charts a little bit later. CFTC net short positioning. So this is something I want to focus on right now. There's two periods I want to look at here. It's when they keep adding to their short like they did in 2020, and like they kept adding to their short into September of 2022, and then they cover a massive amount. They cover a massive amount. And this week, we saw a massive cover, about 90,000 shares. I'm going to put a caveat on that because it could be a cash settlement for the S&P 500 futures, which means they're going to want to sell it back next week, just like they did here into September and October. But I'm not 100% sure. So let's see how we could squeeze higher. I told you maybe it's time to consider selling the extreme greed, but doesn't mean we can't go higher. Let's look and see what happened when the short got removed. So we're looking here to late June of 2020, and we're looking to September of 2022. All right, so here we have June of 2022. We're looking at this yellow box. What happens? We have our all-time high. We bounce all the way back up almost to our relative high, which is what? Our February gap. What happens? We get a push lower, we get a flag, they cover, and then the market melts 60% higher to our all-time highs that were established in 2022 or a year and a half later. This appears like it was a good buy when the shorts started to cover. So now let's look at September of 2022. Why? Well, we bottomed within the month. So late September is about right here. There's your pop. There's your fade. They cover into here. And then we we go down, form our 2022 low, higher high, higher low, higher high, higher low, higher high. Okay. So I see something very similar to 2020 where we have that clear zone of digestion. And if we don't get a leg down, it just means we don't know where that higher low is going to get staged. We have to keep forming higher highs and higher lows and keep closing over the candle highs. If the squeeze is going to continue without a breather, it means we're driving all day and night, and the bulls want to make it right to the next Fibonacci extension at 450 ASAP. So what this implies for me is that if we're going to keep continuing the pattern of expansion, it means higher lows, higher highs, which means we have to get above 432 this week. And then I would like to see us close above 432, which would mean another close in bull market territory, a close over our August high, and that gets start to invalidate the seasonality chart one more time. This is going to be very important for Jerome this week because he has a very fine line to balance where we note that Canada, after the Bank of Australia, have raised interest rates. They paused and then they raised. So right now we're talking about a pause for June, but we're also talking about a 50 basis point hike potential for July if they're wrong. So 50 basis points in July if they're wrong. And I want to show you the reasons why we have to be receptive to that. We look here to the Bank of Canada surprised. They're not as high as the Fed right now, but that's what the market predicted. And this is going to be important because we have CPI on Tuesday, headline expecting to come down from 0.4 to 0.3, core stuck at 0.4, PPI, but then the Fed decision on Thursday, that summary of economic projections, which I alluded to briefly before, and then we have the ECB rate decision and CPI coming in on Friday. The CPI print for Europe could be received quite well to end the week off. And with all of that said, right now, the Fed Watch tool from the CME is telling us that there is a 70% chance of a pause in June, which means on Wednesday, and a 30% chance of a hike, which means the base case right now is pause, and the market has already priced that in. So the surprise, or how we could have a big move, is if that doesn't happen, if they decide to hike anyway, or if Jerome Powell comes out with a really hawkish pause, which we're already baking in, but maybe he's going to surprise us. So that's what we're looking for here. And now we briefly talked about that summary of economic projections, which we were last provided on in March, which means with the meetings here from the Fed, every time there is an asterisk or the star, it means that is a meeting associated with the summary of economic projections. So what I mentioned before when we were doing these previous outlines is that if the Fed is going to pause or pivot, it is likely going to need to be accompanied with what? With data. So those are called the summary of economic projections. Why? Because they say they're so data dependent. So if they're going to take a pause, it would be natural for them to do that now in June, or I would think it would have to be in September. Here's the problem. So we get one in June, we get one in December, we get one in December. So if they pause now and they hike in July, a pivot could be communicated into September, or a hike could also be communicated. We don't know. So what does this asterisk mean? Because I'm a little bit confused, Justin. All right. Well, let's go over here and we'll talk about the heat map in a moment when we look at the charts. If you haven't already, I would really appreciate if you could please smash a thumbs up and consider subscribing to the channel. Thank you ahead of time. I really appreciate your support. So what this comes down to is the way the Fed makes decisions is they look at the data and then they determine whether or not it is accurate or not. So here we look at the key figures they're looking for. And if you're confused here, let's just take a quick screenshot so we can actually understand what these numbers are telling us. Most important numbers here are going to be the ones I'm going to highlight. So if you're confused, please just hang with me for a few more minutes and I will explain to you what I am looking for. So I'm not sure what's going to happen on Wednesday. Pause, hike, I don't know. What I am more interested in is the Q&A and the SEP. So what does Jerome Powell actually say? He's likely going to be asked about Australia and Canada, who both paused and then hiked. Are you going to do the same, Jerome? Are you ready to do it? And then I'm focusing on these numbers here. We're looking at what the Fed told us in March, what they thought the full year or the entire 2023 would be for GDP. They told us 0.4%. Well, we know that's coming in red hot. So this number seems like it needs to get adjusted. Unemployment rate also needs to get adjusted. PCE also needs to get adjusted. Core PCE likely also needs to be adjusted. And if these numbers here need to be adjusted, what I think is that they're going to likely be either raising this Fed funds rate or Jerome Powell is going to say we're ready, willing, and able to go higher. So let's digest these numbers one by one right here. So here's what we have. The last time they give us this projection was in December, and they gave us 0.5. Then they reduced it to 0.4. So where are we now? Because that is going to really matter. If we're going to be averaging 0.4 for the entire year of 2023, well, right now we got 1.13 and 2.1, which means an average of about 1.6%. So, Justin, this seems really easy here. If we're looking for 1.6% into the first half of the year, what do we need to be into the second half of the year, right? Into the second half for that 0.4 to be averaged out here? Well, it needs to be roughly negative roughly 0.5%. So for the entire second half of the year, that's correct. Why? Well, because 1.6 is too high. Even if we go to 0, it's going to be 0.8 at the end of the year, not 0.4. So there has to be one of two things that happens. The Fed is either going to be looking to induce a recession into the second half of the year to save the 0.4% projection, or they're going to revise this number higher. I don't know what they're going to do. I'm not Jerome Powell. I have no idea. This number right here just seems like it is wrong. It is wrong. It is wrong. And if the growth rate is above trend, what's the next most important data point? Well, let's look here to unemployment rate. And then we'll look at PCE, and then we'll talk about the Fed funds rate. And hopefully you're sticking with me because I know this stuff is complicated. All right. Same thing here. For the entire year of 2023, they thought the unemployment rate was actually going to tick down from December. So that's them saying we're winning the fight. But for the entire year, they think 4.5%. Well, where are we right now? Let's look here to our next data point. So here we have the unemployment rate. January, 3.5, 3.4, 3.6, 3.5, 3.4, 3.7, call it 3.5 average. So again, if we're averaging about 3.5%, but the Fed has told us that we want or we expect 4.5, first half of the year versus second half of the year, we have that same problem again where 3.5 can only, this is just simple math, can only average 4.5 if in the second half of the year we get 5.5. That's like really high. That's like a lot higher than right now. This labor market is sticky, it is stubborn, and it doesn't seem to want to do it. So again, what's the Fed going to do? Are they going to lower this number? Or are they going to say we're ready to raise interest rates higher if needed to get to 4.5? That's also a risk. What's the next risk here? We're going to look at core PCE. We're going to skip PCE just because this is the Fed's favorite inflation gauge, this one here. So look at the number. It's 3.6. That's what they want inflation to be at for the balance. Sorry, for the entire year of 2023. Well, let's look at that number too. Oh my goodness, it's stubborn at 4.5. So exact same thing. If it's currently at 4.5, but we want 3.5 for the year, what does that mean? Inflation has to half down to 2.5 averaged out for the entire second half of the year for this target to get met. Otherwise, the Fed needs to either revise this number higher, which means this number needs to go higher, the Fed funds rate, because what the Fed and Jerome have told us is that the core PCE plus 1.6% is how we get this Fed funds rate. So if right now 3.6 is not happening and the Fed is already at 5.1, that's why they have to be ready for a 50 basis point hike or more at the July meeting or after. Why? Well, let's look at the number here. It's currently at 4.5%-ish. So 4.5 plus 1.6 is equal to 6.1, which is going to be over 1% higher, what they told us in March. And they might just have to wait for the data. They might be waiting to see if these numbers come down closer to where they want them before deciding to hike again. So I know this stuff is confusing. I hope I did a good job at laying it out as simply as I can. And what this really comes down to is the Fed is behind. GDP is too high. Inflation is too low. Inflation is too high. And they're already at 5.1. So I don't know which numbers out of here will change, but I do know Jerome is going to have to address them during the Q&A. So as important as the headline number, meaning do they hike, do they pause, that's going to be important, but we have to also pay attention to what could happen. We noted if they pivot, that could happen later, that happens after a pause. We also talked about what could happen if the shorts continue to get squeezed, which means we close higher regardless of what Jerome says. And the way I could see that happening is if this 1 week performance where we see a lot of green or breadth and depth is what we call that. The names that are red are Meta, Nvidia, Google, Microsoft. Even after the product launch for Apple, it's flat. I thought it would be down. It's not. I was wrong. So we look here to the 1 month. And what I'm noticing is that the pockets that are deep red are not green enough. They're not close enough to neutral, which means that we need to see broader participation for the market to be healthy for a leg higher. Going sideways would also be healthy. Why? We can digest the most recent move that we've made. So as we look here to a few charts, here we have the S&P 500. We have it in a weekly higher low and a higher high and over the previous candle high. So if that pattern happens again, regardless of what Jerome Powell says and the Fed decides, if we close above 432, that would be a higher high, a higher low over the previous candle high. It would be a claim for a second week of our Fibonacci area, which would open up the door for us to get the 450 or the next extension. And then also that August high, which is what QQQ has already done. It's 60% retracement here was at 350, and we're closing out here at 355, battling for that downtrend right now. On the flip side, if we look here to the DAX had a little bit of trouble as it got to its all-time high. So here is something that the S&P has not been able to do. It's not been able to leg higher all the way to its all-time high. So our all-time high at roughly 16,300, the DAX hits it, and then it pivots lower for 3 red consecutive weeks. They're still dip buying it here, which is similar to what we showed you for that CFTC net short positioning on the S&P, where we get that little bit of a higher low, and then it goes higher. So I do want to see the DAX go to new all-time highs if the global market's going to expand, and I want to see the S&P leg up over 430. In addition to that, there's 2 more charts I find very important here, maybe even 3. So first one we're going to look at here is going to be the dollar. And the dollar is important because there's 2 competing patterns here. The first one is a head and shoulders, which you can clearly see with what I've drawn. And the second one here, depending on what the Fed says, because that's going to move the dollar, we could be set up for a W here. If those numbers I talked about in the S&P get revised, the dollar might be heading higher. I'm not sure, right? I'm putting a big question mark on that. I don't know what's going to happen, but it's notable for me. I would also note that the 2-year note has been up, right? It's closing right here at 4.6. It looks like it just wants to go up. It's already doing that W we're looking for on the dollar. So this is telling us that the bond market's like, hey, we think Jerome's going to keep raising and he's going to hold higher for longer. We can also note that VIX is at a level we have not seen since 2020. So this is a time when you buy insurance. Why? You buy insurance when you don't need it. Notice all the fires happening in Canada and all the smoke going into America. Yeah, you don't buy the fire insurance after the fire is announced. Which is what for the market? When the market's in extreme greed, we're at the low 13s, and we've not seen this number going all the way back to the big C, which happened in February of 2020. 13 is the lowest of the teens. It implies the market is calm, cool, collected, not worried about anything, and expects to go higher. That is where the surprise could come in. The surprise of the Fed being hawkish, a data print coming in hot like CPI, or something else, a little bit more of a surprise. That is really notable. The market is basically pricing in a perfect soft landing, no hiccups from here, and Jerome Powell is going to be our savior and Lord. So looking here to Bitcoin, it's down 4 on the week. Ether is down by 7 on the week, which just shows us some de-risking of large asset classes. And then other than that, I think I'm probably going to leave it there because I left you a lot of information, and we're really going to be focusing on the big man on Wednesday at 2 p.m. So I encourage you to consider smashing that thumbs up and subscribing to the channel because we will be publishing videos every single day this week to provide updates. And we now have our Friday stream queued up here on the left-hand side if you want to see what we were talking about and hanging out on Friday. Thank you so much for tuning in. I look forward to seeing you on the next one.